Another day, another disappointment. That seems to be par for the course for trading here recently. We woke up this morning where we had an upgrade over at GE. That stock was flying higher. Of course, GE has struggled mightily this year, and so there were some positive vibrations coming through the US stock market. But by the end of the day, again, the sellers took over. What's new? And so we did close lower on many of the different indices out there. Needless to say, we remain bearish with our posture across most of the US equity indices. So today I wanted to focus on a technology-oriented stock for our trade application where they've just gotten some new competition in their field. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's December 13th, 2018. First of all, if you're new, welcome aboard. We're grateful to have you in our audience here today. Remember, you can subscribe to our YouTube channel, and while you're there, make sure you sign up for our email distribution list, which entitles you to the stocks that are giving you overbought and oversold cluster signals in the S&P 500 each day. In addition to that, we're also heavy users of Twitter. Make sure you're checking us out there. My handle is @BrandonVanZ, and anytime you see any posts related to the Market Outlook video, be sure to click like and retweet if you get value out of these videos on a daily basis. In addition to that, we also have a presence on Facebook. Make sure you check out our group and the web address that's embedded in the logo in front of you. All right, with that, let's go ahead and dive into the analysis here today. As you can see, I've got chart 4B pulled up in front of us here. This is your foregrid for the market forecast view that we use here. And it's kind of giving us a good sense of, side by side how the various U.S. equity indices are doing. And unless you've been living under a rock, of course, since October 1st, it hasn't been doing all that well. There's been more bearish days than bullish days. And while every so often you get a couple of elements of positive news that creep out, more often than not, that's given way to more selling by the time it's all said and done. So this has certainly been a more difficult period for investors compared to what we had been experiencing over the last couple of years. Well, as it stands here today, we were down 0.02% on the S&P 500. Let's just call it flat. But that was off the highs of the session. And of course, we remain bearish according to the market forecast indicator. Remember, this pink colored background here is identifying when this green intermediate line, which we use to set our posture, is either pointing lower like it is right now, or if it were just in the low reversal zone down there below 20. So that kind of is the story with all of our indices right now. Notice that all of them have that pink shaded background there telling us that we've got strongly bearish intermediate postures. Now, of course, there's always going to be slight differences depending on which index that you're looking at. I would say that the one that seems to be holding up a little bit better right now is the Dow Jones. You'll notice that the Dow was actually up 0.29% here today, so it kind of separated itself from the pack a little bit here today as we've seen a little bit more resilience in some of those mega cap names. Some of you that follow me on Twitter may have noticed my tweet about Procter & Gamble earlier today, of course being one of those dividend aristocrat Mount Rushmore stocks that I talk about so often in my dividend growth investing classes. So Procter & Gamble soared to all-time highs here today. So when you have those big mega cap stocks like that holding up, you do find that the Dow tends to hold up a little bit better than some of the other areas as well. Russell 2000 continues to be our problem child. Notice that the Russell 2000 was down another 1.55%. Notice that we closed near the lows of the session on the Russell 2000 here, and of course remain below that falling moving average. Notice that the green intermediate line on the market forecast indicator is in the lower reversal zone. In fact, let me right click and go to maximize sell here. And you'll also notice that there's this dotted orange line that represents our market sentiment. Remember that if you're having a hard time seeing that dotted line, you can just simply read the label itself. But that market sentiment line, it should be noted, is at 16.6 and falling, as you can see right here in the label. And so that reminds us that even from a long-term perspective, not just intermediate term, but long-term perspective, we also have a bearish posture on the Russell 2000. All right, let's go ahead and take a peek now at our next chart setup. This one will be chart 4C for those of you that are following along at home. This one is going to be our 3 green arrows chart setup, or in this particular case, it would probably be more aptly renamed the 3 red arrows setup, because that's where we stand with all 4 of our indices right now. You'll notice that the background color of our charts currently are light pink in all of these cases. And then on this particular chart setup here, we're referencing the 3 green arrows philosophy, which are basically 3 different technical indicators. The first one is going to be our moving average, and we use a 30-period moving average. So this would be a 30-day moving average up here. When price closes below that moving average, we would generate a red arrow. When the MACD trades below that 0 line, that would generate a red arrow. And in this case down below here with the stochastics, we have what's known as a phantom red arrow there as well. So generally speaking, if you're looking for trend trading opportunities, you might be able to find better trend trading opportunities on the bearish side of the equation rather than the bullish. Of course, if you want to be bullish on the markets, you would rather have the opposite of what we're seeing right now. You'd rather have 3 green arrows. So no matter how you slice it, 3 red arrows across the board and bearish postures also, according to the market forecast indicator. Let's take a look now at our 1040 crossover chart. This is chart 4D for those of you that are premium market scholars that are following along at home with your own charting package. Now notice that I shouldn't say all, but 3 out of the 4 of these charts that we're looking at here now have what's known as death crosses, or kind of bearish sentiment shifts from the long term. These particular charts right here are going to go back over 3 years in time, and each one of the candles that you see on the chart represent 1 week in time. Now you'll notice that there are 2 different lines on each of the charts, one of them orange, one of them blue. The orange line is the 10-period moving average, so since this is a weekly candle chart, so this is a 3-year weekly, so that orange line will represent a 10-week moving average. The blue line will be a 40-week moving average, and we're simply looking for crossovers of those moving averages to give us clues as far as what our expectations are for kind of longer term. And as you can see here with the S&P 500, we now have a bearish crossover there, which occurred last week. We got the bearish crossover on the NASDAQ, which occurred maybe 2 or 3 weeks ago. And the Russell 2000 actually was kind of our laggard or our leader, however you want to think about it. But anyway, it was the first of all the indices to do the bearish crossover, and that actually occurred back here at the end of October. Now, the Dow Jones, as I kind of mentioned earlier, remains the most resilient index here currently. You'll notice that the Dow Jones just barely hanging on to positive crossover at this current juncture. Once this black line right here comes down below this pink line, that would basically tell us that we also have a crossover up here on the moving averages themselves. So at this point, we don't have a death cross on the Dow Jones, which again focuses on those 30 mega cap companies. But just judging by history and where the momentum of the market is right now, I would fully expect that a death cross will occur on the Dow Jones here in the coming weeks. So we'll keep our eye on that. And of course, when that happens, we will let you know here in these videos. All right, let's take a peek here now at our chart 4E. This will be our 12 grid to look at the inner market analysis. And remember, when we see the pink background colors, that will identify bearish postures according to the intermediate line on the market forecast. And anytime we see green backgrounds, that identifies bullish postures. This first set of 12 grids here doesn't really have much to do about the stock market, but oftentimes looks at things like treasuries and commodities and different things like that. So a couple of the areas we've been focusing on a little bit more so recently have been the US dollar and then also gold. Those are your 2 charts kind of in the lower left-hand corner of our screen right here. Notice that both of them continue to maintain that green background color, telling us that we have bullish postures on each of those entities. And notice that they also have this green colored moving average as well. Remember, those moving average colors themselves do change. So for instance, up here, this is a good one to kind of educate you on from that perspective. With TLT, it had this red moving average for much of the time period between September and November, and then eventually prices started to revert back higher, and once prices went above a rising moving average, that moving average turned from red to green. So the idea there is, if you believe that markets are strong, or stocks, or whatever it is that you're pulling up on your chart, then you'd want to see their price action giving you a series of higher highs and higher lows, and trading most of their time above a rising moving average. And that is what we are seeing here currently with the US dollar and gold. And as I was mentioning in the presentation on Tuesday, I happen to believe that that's because those are viewed as more safe haven oriented areas right now. Traditionally, you don't see a whole lot of times where gold and the dollar travel together, but because of the more chaotic conditions that we have right now in the marketplace, I get the sense that that is what is indeed taking place. As far as bearish trends that are developing, we've been in a bearish trend for quite some time here with crude oil. We actually had a decent little pop in crude oil today, so keep your eye on that. We were up 3.7% in crude oil today, but obviously we've got a lot of work to do before that chart starts to look a little bit better. Another bearish chart to be aware of: preferred stocks up here. Boy, those things look ugly. Right now, that what we use as our proxy is PFF, so that's an ETF that tracks the preferred stock market. And you can see it's just lower highs and lower lows across the board here. And it doesn't matter that we're getting all these oversold cluster signals. Remember, oversold cluster signals, just like any technical indicator, are going to work better on some charts than others. So, we do our best to try to identify those. So as an example, foreign bonds, it worked really well to look for those. But there will be other charts like preferred stocks where it just doesn't seem to respond to that particular technical indicator. So right now it is a house of pain in preferred stocks, as we've seen some chaos there in some of the interest-sensitive areas of the market. Let's take a look now at our next 12 grid, and this one will be our foreign stock markets 12 grid. Let's take a peek at that, and you can see it's a clean sweep for the bears here. All 12 of these charts are pink, telling us that from an intermediate term perspective, our posture is bearish. Some of the charts look a little bit better than others, but for the most part, it's either sideways or downward trending price action. There's not a whole lot of upward trending price action. We were seeing some bouts of strength within India and China, and it is good and promising to see that price is above a rising moving average in both of those cases, but it just hasn't been enough strength to thrust prices high enough to turn the posture of the intermediate term around quite yet. So those two are kind of like right there, borderline, going between bullish and bearish. If they can have some more stabilization days to the upside, we might revert back to a bullish posture. But right now, again, clean sweep across the board. So it's not just here in the United States where there's ugliness. There's basically nowhere to hide in terms of true stock markets out there, at least from the major economies of the world. Let's now take a peek here at our U.S. sectors 12 grid. And as you can see here, we've got one place to hide out, at least if you're looking for a bullish posture, and that is utilities. Utilities remain very strong, in fact, hitting a new multi-month high on an intraday basis here today. In fact, a closing high basis as well. So we didn't close at the highs of the session, but the closing price that we did have was higher than the closing price of 2 sessions ago. So utilities remain very, very strong in this marketplace, but most of the other sectors are really struggling, and that's generally not a great sign for the health of the overall market. Remember, it might be, you might be somewhat thankful to have utilities doing well if you have utility ownership in your portfolio, but that typically means that the rest of the market is struggling on a relative basis. And so it's not always the greatest of bullish signs that are out there. So right now, it is a difficult time period no matter what sector that you're in. But the areas that seem to be giving you a little bit more resilience are those more defensive areas of the market. If we come over here and take a look at the Market Watch tab right now, remember, this will sort these sector ETFs on a one-day basis to kind of give us a feel for what was happening with trading just today alone, as opposed to the 3-month view I just was showing you. And you'll notice here, XLU right up there at the top. It was up about 0.8% here today. Right below it was real estate, and then consumer staples. So those are pretty much your most defensive areas of this market, and so it's not a big surprise to see those three being the leading areas of the market right now. On the downside, we did have materials. So remember, I did that bearish materials trade with Vulcan Materials 2 days ago, so that helped that trade a little bit there. They continue to get hit here from the materials space. We also saw the financials struggling again today. In fact, we had some good conversations here today in my question and answer class. Remember, I conduct that on Thursdays. For those of you that are Premium Market Scholars subscribers, you're welcome to join me on Thursdays, where you can ask me direct questions about individual securities or my thoughts on the market. You can do the same thing for David on Saturday mornings. So today we did talk about stocks like Wells Fargo, stocks like Emerson Electric, stocks like Broadcom, stocks like Clorox and Phillips 66 and Amerigas and Ameriprise, Target, UPS. So had a lot of good stuff going on right there today. So feel free to check that out if you are a premium subscriber. While I'm over here on the internet, quick reminder that you can check out my 9 at 9 every trading day morning at 9 a.m. Eastern time. So that gave us a good heads up this morning that GE was going to be one of the leading stocks on the market here today. As you can see on the pre-market session, GE was up over 12% there. In addition to that, the sector selector will be produced here tomorrow night. Remember, I produced that on Friday nights. And again, remember that has been giving us some great insight about the market here recently. You know, I mentioned utilities, real estate, and staples leading the market here today. Well, it's been much the same for quite some time. You know, the utilities have been a leading area since basically the beginning of October. And so it's not entirely surprising to see them leading on more days than not when we get together and we have these daily summaries and review of trading in the market here with the Market Outlook videos as well. So make sure you're checking that out. And then lastly, remember that if you are watching these Market Outlook videos on our website, remember you can go over here to marketscholars.com and click on blog. You can actually watch this right here. David's class, by the way, is going on right now, so the recording should be available for his portfolio management class a little bit later today as well, for those of you that are premium scholars. But anyway, if you get value out of these videos, make sure you're clicking like here on Twitter, give us a thumbs up on Facebook, and click like on our website as well. I appreciate the 97 of you that clicked like the last time around on Twitter. I know many of you do that on a regular basis, and we thank you for it. Generally speaking, if I can get 100 or more likes, I figure that these free videos that do take up a couple of hours worth of time to produce every day are worthwhile. And remember, between Christmas and New Year's, we're going to be kind of going dark on these videos. And as always, we will evaluate whether it's worthwhile for us to do these videos for free for you guys every single day, or whether we want to go a different direction with things. So the way that you guys can let us know that you get value out of these free videos is simply contributing your click. Pretty easy ask for most of you. All right. Lastly, let's go ahead and take a look here now at our trade application example for the day. And so I'm going to come back on over here to chart 4A. And as we pull this up here, I'm going to go over here to this stock called Spotify. Now, for those of you that are music aficionados, you should be familiar with Spotify. It is one of the biggest music distribution companies on the planet these days. It was kind of interesting because earlier this week, some of you might have heard that Tencent Music did their IPO here in the United States. And of course, they're one of the big music distributors over in China and Hong Kong and other areas over in Asia. But here in the United States, Spotify is kind of the big kahuna along with Pandora. But all of those areas are kind of struggling. You know, it's a difficult market when you've got such intense competition out there. And that's great for consumers that want to consume music, but it may not be great for profit margins at the companies themselves. And so today's trade application, since we do have a bearish posture in the market still, will be a bearish trade setup on Spotify as well. As you can see here, over the last 3 months, this stock has been stuck in a series of lower highs and lower lows. You know, we basically topped our highest level on the chart exactly 3 months ago at about $187 and hit as low as $120 here at the end of November. But generally speaking, every time we get a reversion to the mean like we did after hitting that low, we come up to this downward trending moving average, use it as resistance, and bounce away from it again. So generally speaking, just pushing away from that downward trending moving average. So the theory is an object in motion tends to stay in motion. Obviously, there are going to be exceptions to that, but the question is now the time where Spotify would turn around and start heading higher? Right now, what we know kind of factually from the market forecast indicators perspective is that this green line is pointing lower, and therefore our posture on this particular stock would be considered bearish at this point, in addition to seeing the price action with lower highs and lower lows. And so there are different ways that you can take advantage of bearish trade setups. On Tuesday with Vulcan Materials, I showed you how to do a long put vertical as a bearish trade setup. Of course, you can just go out and short the stock outright if you want. But today what I thought we would do is look at selling a bear call spread. That particular option strategy will allow us to receive a premium or a credit up front in the hopes that the stock continues to go lower or at a minimum just sideways, because that particular trade idea does make money off of time decay. And so it does provide a little bit more flexibility the way that we set them up and sell the strikes that are out of the money. And it allows for you to not have to be perfect with your entry. As long as you're just generally right, you don't have to be perfectly right, and you can still profit off of this trade idea. So let's go on over here to the trade tab and take a peek here at our January contracts with 36 days left until expiration. I typically focus on those contracts between 20 and 60 days that are in the monthly category. So in this particular situation, this would be the black font as opposed to the purple font up here that talks about the weeklies. The monthlies typically have better liquidity, which is why we tend to focus on those a little bit more. So as we come out here, what I'm going to do is I'm going to look for a delta that's close to 30. There is a delta of 34 right here. That's going to be our 135 strike call that we will sell here in January with 36 days left until expiration. So I'm just going to right click. I'm going to come up here to sell on the Thinkorswim Paper Money platform, and then I'm going to come up here to vertical. So I'm going to sell a vertical, and you'll notice what it does is it loads up this trade where we've got two different kind of levels of the trade. The top level says a -1 up there, which is basically saying we are selling one contract of the $135 strike call, and as part of the same trade, we are buying one contract of the 140 strike call. Now, the net effect of those two things, where you're selling one call and you're buying another, in this particular case, our net effect of that is a credit of $1.25. So it's not a debit. This is not something you pay out of your pocket. This is something that you receive up front to start your trade. And the idea here is for you to be able to keep as much of that credit as you can. As long as your analysis of the security is correct, you should be able to keep most, if not all of it. If your analysis of the security is incorrect, which we'll all be wrong plenty as traders, then unfortunately you won't keep that. In fact, you might end up taking a loss on it. So one thing that we do try to do is get at least a 30% return on risk when we initiate these types of trades. For those of you that are curious on how you can figure out what your return on risk is, remember, if you just click the confirm and send button once, you'll have the information you need to make that calculation right there. So let me get my calculator out here, and you'll notice here that it says our max profit on this trade is $125. Now, again, I'm only doing one contract here, so you guys can position size whatever's right for your own personal situation. But with one contract, we would make $125 at the max. We would divide that by the most that we can lose, which in this case is $375. And again, I'm getting that number right there. And that means that our return on the amount of money we're risking is 33%. Now, this is a higher probability trade because you'll notice that our break-even price here is $136.25. Notice that this stock right now is trading at $125.55. So in other words, In order for us to not make money on this trade, which we believe to be in a bearish trend right now, this stock would have to go up over $10 per share, or just at $10 per share, right around that area, for us to be wrong. So while we think the stock is going to go lower, even if it doesn't, let's say the stock doesn't go lower like we think it is, let's say it goes sideways, well, we'll make money on that trade idea. And even if it goes up, let's say that we're just flat out wrong, we thought the stock was going to go lower, but instead it goes up by $5 per share, because it still didn't go up beyond our break-even price, we would still win that trade idea. So it's not until we are really, really wrong and the stock goes up more than $10 per share where we start losing money on that trade. But the nice thing about this is it is defined risk. So our worst case scenario is that we would lose $375. So that's kind of nice as well. Remember, sometimes when you're shorting a stock outright, you don't know what your worst case scenario is, because a stock can theoretically go up forever. So anyway, we'll go ahead and place that trade on Spotify to give us an example there of a bearish trade idea during this bearish posture moment that we have with the markets. All right, well, I want to thank you for joining me here tonight. It's always a pleasure to go to work for you. Remember, David will be with you tomorrow. I'll be back with you next Tuesday. Enjoy your weekends. Of course, another big weekend for fantasy football. I've got my semifinals coming up here, so we'll be keeping my eyes tuned on the NFL this weekend, and then get back to the swing of things with the market on Monday morning once again. So I want to thank you for tuning in here tonight. Best of success with your trades and your investments. Goodbye for now.